Now, if you're like me, you may have seen LLCs and S-Corps and been thinking to yourself, wow, these seem like the two best entity types. And yeah, they are incredibly beneficial for someone looking to create some entities that have limited liability as well as limiting that taxable income, getting only taxed once. Now, they're both popular entity business types, several key differences. Let's walk through and compare them. And do I compare certain entities a little more than others? Yeah, and that's generally because maybe they're more similar to each other and you want to know the differences, especially. We do have a lot of graphics, a lot of great memorization charts to run through. We'll have our memorization guide, lots of comparisons between the entity types, but specifically, we're looking at LLCs and S-Corps here. Now, ownership, LLCs can have an unlimited number of owners known as members. These can be individuals, corporations, or other entities. So again, other entities important there. S-Corps, on the other hand, can only have up to 100 shareholders, which definitely memorize that, who must be individuals, estates, or certain types of trusts. So you see, you can't have other corporations as shareholders of S-Corps. A little more restrictions, again, kind of balancing out the entity types. It's kind of like the IRS is nerfing or buffing various entity types throughout. Management, LLCs can be managed by the members themselves or by a designated manager, who can be a member or an outside party. S-Corps are managed by a board of directors who are elected by the shareholders, so just more in line with the corporation overall. Now, LLCs are generally taxed as partnerships by default, meaning that profits and losses are passed through to the members and are only taxed at the individual level. However, LLCs also have the option to be taxed as a corporation if desired. S-Corps are also pass-through entities, meaning that profits and losses are passed through to the shareholders and only taxed at the individual level. We saw how that process worked on those tax forms prior. Self-employment taxes. LLC members are generally subject to self-employment taxes on their share of LLC profits. S-Corporation shareholders, on the other hand, can avoid some self-employment taxes by paying themselves a reasonable salary and taking the remainder of their profits as distributions. This is a point as well you may see on the exam or just see throughout, is a reasonable salary. Now, this is something you're required to do. The IRS requires you to do it if you are a worker of your own entity as well. So if you're considered an employee as well, you have to pay yourself a reasonable salary. You can't pay yourself $1 to avoid certain taxes on something, but you can't pay yourself also every single dollar to avoid other taxes. You have to pay yourself a reasonable salary. And there's actually charts and online that you can go on the IRS's website and kind of look at what a reasonable salary would be, compare yourself to other entity types at various income levels as well, similar to your own entity. Now, formalities, LLCs are generally less formal than S-Corps, meaning you don't have to wear suits to the meetings. Just kidding, that's my rule. With fewer requirements for meetings, resolutions, and other formalities, S-Corps are subject to more formalities, mainly because it was a corporation that elected to become an S-Corp, and corporations are basically one of the most formal type of entities you have there. They must follow strict rules regarding shareholder meetings, record keeping, and other matters. In terms of flexibility, LLCs are generally more flexible than S-Corps in terms of ownership, management, and other matters. Now, LLCs can choose to be taxed as a corporation if desired, giving them more flexibility in tax planning. Overall, these are two great business types. I'm not here to recommend which you should start on your side business. However, this is something you'll have to distinguish between on possible SIMs, multiple choice questions. What type of entity are we describing? Or what type of entity is best for whatever group of people we're describing? Is it two people trying to start a business? Is it one person trying to start a business? Whatever it might be, that's something you'll have to know, understanding the comparisons between these and then applying them to situations as well. All right, and as promised, here is an example of choosing the best business structure. Now, again, you may see Sims where you have to run through a bunch of situations like that, or one big situation. We've got individuals wanting to start a business, a group of individuals, maybe it's just one person, maybe it's two companies wanting to start a joint venture, right? That could be an answer as well. So these are just the situations you could run into as well. We want you to consider the tax implications, make sure that the criteria are actually being followed, right? You can't, even if an entity sounds great, if the criteria are not being met, then you can't choose that option for sure. Now, here's an example as promised. John and Jane are two friends. They want to start a business together. They've decided on a name and a business plan. Great. The name's probably the easier thing, but they're not sure which legal entity to choose. That's a little more difficult. And that's what you're going to be doing here. Now, just because you do very well in these questions does not mean you should start giving legal and tax advice out openly to anyone who asks. However, you can rest assured internally that you are good at this. They've considered the following options. We've got a general partnership, limited partnership, C Corp, S Corp, sole proprietorship, or LLC. So for example, in a SIM, you may see a drop down with all of these as possible choices. They're going to need to consider the following criteria when they make their decision. And this is where in the SIM, you would see these are the items that they want to have with their new entity. So liability protection, they will need to determine the level of protection they want against personal liability for business debts and legal claims. So the question may say they care significantly about legal protection, in which case sole proprietorship would probably be off the table because sole proprietorship offers no personal liability protection, whereas, for example, an LLC does offer some limited liability protection. So we see how we would eliminate some entity choices and possibly inch towards others as well. Tax implications, they're going to need to consider how their chosen legal entity will be taxed. For example, a sole proprietorship and partnership are both taxed as pass-through entities, which means that the business income and losses are reported on the individual owner's personal tax returns. On the other hand, a C Corp, which is a separate entity, and profits are subject to double taxation. Now, there's a couple situations within this that you should consider as well. If these individuals have other income from other sources and their income is incredibly high, then it may be actually beneficial because a C Corp, well, it's capped at a certain amount. The dividends have a cap, right? You're not going to have as high as the just normal individual income tax bracket. So actually, if you have incredibly high income, a C Corp actually may be a good choice for you because a C Corp has a flat 21% tax rate. And then let's say, the highest dividend tax rate in the current year is 25%. But let's say you make $1 million and that would put you into the 39% tax rate for individual income taxes. A C Corp would be a good decision in that case. So lots of things to think about and to consider. Now, management structure, John and Jane will need to decide how they want to manage the business. For example, a general partnership and limited partnership offer flexibility in management, while a corporation has a more rigid management structure. They may talk about how one person wants to be more involved with the actual operations, whereas one person wants to be kind of more of a passive investor. And then lastly, cost and complexity. John and Jane will need to consider the cost and complexity of setting up and maintaining their chosen legal entity. If they don't want a lot of work, then you may want an LLC or a partnership. If they're okay hiring a lawyer to help them and hammer everything out, maybe a corporation would be on the table. Now, for example, setting up a corporation involves more paperwork and legal fees, and they can do it themselves. You don't need to hire a lawyer, but if you want to, I guess, do the best job possible, yeah, you would hire a lawyer for sure. But based on these criteria, we could consider the following options. General partnership, this is going to offer flexibility in management and pass-through taxation, but does not offer personal liability protection. And you may think, okay, let's say a sole proprietorship is off the table is just because there's two people here. They could work together and each report their income from that as a sole proprietorship. I would say for the purposes of the exam, it's a little sketchy. We're probably not going to choose that option because at that point you would classify that as a partnership, but just kind of something to consider as well. LLC, this is going to offer limited liability protection and pass-through taxation, but it may be more expensive and complex to set up and maintain. And then an S-Corp, this offers limited liability protection and pass-through taxation, but has more restrictions on ownership and may be more expensive to set up. Now, overall, did we actually run through a situation here and decide which was the best for them? No, this was just getting you to consider all of the possible factors you could see. So for these questions I'm referring to, you're going to have to run through John and Jane want this, they don't want that, they want this, they don't want that, and you'll have to, at the end, determine what is the best entity type. We've got some great examples and questions coming up, but let's keep running through. I know this is a long lesson. You're doing great. You're doing wonderful. Keep powering through. Let's talk about an owner's basis. So let's start from the bottom just because I want to. I'm a little crazy. Let's say I invest $10,000 in a corporation. Well, that's going to be reflected through the basis of the stock. I invest $10,000 in Home Depot. I now have $10,000 of Home Depot stock. Now, because that's Home Depot, it's a publicly traded company that fair market value is going to fluctuate day to day, minute by minute, and I could have a gain or loss right away. But for example, partnerships, S-Corps, you're not trading those shares or ownership interests on the open market. So you're not going to have a constantly fluctuating amount of value there. So just one thing to note, that's what we mean by basis. So that's your basis for a C Corp. But let's say you get into an S Corp and you contribute $10,000. That's the same thing. Partnerships, same thing. LLC, same thing. What is your basis? Your initial basis is just your contribution. Now, we do have lessons that talk about your basis, and there are going to be certain factors that affect your basis, such as the liabilities assumed and lots of other wonderful, wonderful things you'll have to memorize as well. But when we're thinking about all these various entity types, this is what we're talking about. The $10,000 that you put in to kickstart the business. Now, for an S-Corp, the owner's basis increases with their share of profits and decreases with their share of losses. Same thing with partnerships. Again, like I said, a lot of similarities here. Now, debt is going to be something different we'll talk about here. But if you, let's say you are a sole owner of the S-Corp, I guess you can't be for a partnership. Breaking my own rules here. All right, let's say you're a 50-50 owner in both of these entities, and the entity overall makes $10,000. So your share of the profits is $5,000. You'd add $5,000 here. Your basis is now $15,000. If there's a loss in either of these and your share of it is $5,000, you'd subtract $5,000, give yourself a new basis of $5,000. Now, basis for S-Corps is not affected by bank loans, but your debt basis will increase with direct loans made to the corporation by the owner. That's something we'll dive into just much more within the individual lessons for these entity types. For partnerships, your basis is also affected by increases and decreases in bank loans. What I say is that's kind of like your skin in the game. So if you are essentially taking on the liability of additional debt, that will increase your basis because it increases your skin in the game. That's what I'll say for now. I would memorize that, and then we'll revisit that when we see the partnerships lesson. For S-Corps pass-through taxation, same thing with partnerships, S-Corps. They both use that same system of the Schedule K to the K1 to the Schedule E, Schedule 1, and finally to the 1040. Let's compare limited liability companies and C-Corps, and I'm just doing this because these two are kind of more related. These two are kind of more related. You can kind of say that. For LLCs, if there's no S-Corp election, LLCs are taxed as C-Corps or partnerships depending on the number of members, and pass-through taxation does exist if it's taxed as a partnership. Otherwise, it's a separate entity taxed as a C-Corp. Remember that whole concept of a single member disregarded entity LLC. Now, C corporations, pretty much think of if you bought $10,000 of shares of Realty Income Corp or any company on the open market. The owner's basis is not affected by profits, losses, or loans by the corporation. Just think about it. You bought your stock, whatever the company's doing. The only thing that affects you is you receive dividends or if the stock goes up or down. And that's not really the company's doing. That's just the open market acting in the free market. Gotta love it. No pass-through taxation. The corporation pays taxes on profits, and then you pay tax on the dividends that you receive when they're distributed to you as a shareholder. All right, we're going to see an example here, items that affect the owner's basis. Now we're dealing with S-Corps and following the rules we just talked about, but using numbers here. An example, S-Corp has 3 equal shareholders. It earns a profit of $30,000 in a year. Now, I guess we're just going on the assumption here that we've got $0 of basis, but we'll talk about that more. Each shareholder's basis increases by their share of the profits. So 3 shareholders, $30,000 a year, $10,000 increase per shareholder. Now, if the corporation has a loss of $15,000 the following year, each shareholder's basis decreases by their share of the loss. So $15,000 of loss divided by 3, that's going to reduce the basis by $5,000 per shareholder. Let's say a shareholder makes a direct loan of $6,000 to the corporation. That's going to increase their debt basis by $6,000. And why would that? Again, well, because you got more skin in the game. Now, S-Corps are different from partnerships a little bit when it comes to that debt. Any debts generally will increase your basis when it comes to partnerships. And then just direct loans from the shareholder to the S-Corps are going to increase your basis. And why is that? And again, generally speaking, if the S-Corp just goes under, well, that debt may not get paid back, so you got more skin in the game. That's kind of the idea. In bankruptcy, you'd be one of the first generally to get your money paid back after those external creditors, but that is increasing your skin in the game, and you're at risk for a little bit more to lose past your initial investment. Lastly, here, profits and losses flow through to the shareholders' personal returns. So each shareholder is going to report $10,000 of income in the first year and a $5,000 loss in the second year. Awesome. Looking good. And just a note on the third point, again, want to talk about that. So as we see partnerships, we'll see that, again, overall, generally speaking, any of those loans made by the partnership will affect your basis because at the end of the day, let's say the partnership goes into bankruptcy, you're on the hook for paying those because partnerships don't have that liability protection. But corporations, you do have that protection. So if there's a general loan that the S-Corp has with a bank and you can't pay it back in bankruptcy, you're personally not on the hook. The S-Corp's on the hook. So that's why we see that difference here. Gotta love those light bulb moments and comparisons between entity types. We're now seeing partnerships. A partnership has 2 equal partners and it earns a profit of $40,000 in a year. Now each partner's basis increases by their share of the profits, so $40,000 divided by 2. That gives you $20,000 per partner. The partnership takes out a $10,000 bank loan, which is going to increase each partner's basis by $5,000. That's the $10,000 divided by 2. Now, again, this is not a bank loan it's not a loan that they gave to the partnership. But again, if the partnership goes under, these partners are directly liable for any liabilities. So that is a concern. That's why we add it to the basis. Profits and losses flow through to the partner's personal tax returns, with each partner reporting $20,000 of income. Up next, we got that LLC, and not really dealing with numbers because, well, If it's a partnership, we just saw a partnership example. If it's taxed as a C Corp, we're going to see a C Corp example. So 3 equal members elected not to be taxed as a C Corp. That's how it works. We're going to go as a partnership or a C Corp. And we are going to talk about how this works further as we see a C Corp example. All right, C Corporation. Again, I think this one's pretty much the most straightforward because you can visualize you bought $10,000 of stock in a company on the New York Stock Exchange. How does that affect you? C Corporation has 4 equal shareholders, earns a profit of $50,000 in a year. The shareholders' basis not affected by the corporation's profits, losses, or loans because, well, if you bought into Fidelity, a public company on the stock exchange, that would not affect you. The corporation pays taxes on the $50,000 of profit made. If the corporation distributes $20,000 in dividend, each shareholder receives $5,000 and must pay taxes on that dividend income with those special dividend rates. Disregarded entities, kind of hinted at them a good amount and just straight up talked about them in other instances. Here's a dedicated slide kind of going through it more for general knowledge rather than memorizing. So just something, if you completely understand disregarded entities at this point, feel free to skip this slide. But a disregarded entity, it's a business structure for tax purposes in which the entity is not recognized as separate from its owner for, again, tax purposes. However, legal purposes, right, that's different. That's totally different. We're talking about just for tax purposes. So you're protected legally, it's a separate entity. But this is for tax purposes. This means that the income deductions and tax liabilities of the DRE flow through to the owner's personal return. Essentially, the business's tax treatment is similar to a sole proprietorship or a single member LLC. Disregarded entities simplify tax reporting and compliance for small business owners. We think about it, makes sense. If you got just one person and it's a small business, you're not going to file a whole separate business return, have to do that, pay TurboTax or whatever to submit it for you. Right, you're dealing with just your own individual income tax return, and you're still protected legally if you've got that LLC. Here are some examples. We've got the single member LLC. Again, as we mentioned, this single member LLC is the most common example of a DRE. When an LLC has only one member, only one owner, the IRS automatically classifies it as a disregarded entity for tax purposes, unless the owner elects to be taxed as a corporation. The income and expenses are reported on the owner's personal tax return, typically using that good old Schedule C for a sole proprietorship. Now, a qualified subchapter S subsidiary, a Q sub, that's a mouthful. Try saying that sometimes fast. I don't advise doing that. You only have so much energy to study. Now, this is a domestic corporation that's wholly owned by an S-Corp and meets certain eligibility requirements. I'd say this is much more common. You'll see this is just another example. I mean, overall, this is really just for background knowledge. The parent S-Corp can elect to treat the subsidiary as a Q-sub, which results in the subsidiary being disregarded as a separate entity for federal income tax purposes. Instead, the Q-sub's income, deductions, and liabilities are reported on the parent S-Corporation's tax return. So yeah, just thinking of it like a wholly owned subsidiary, something like that. IRS is not really going to view it as its own entity. You're just going to consolidate there at the parent level. Now, it's important to note that while disregarded entities are not recognized as separate entities for federal tax purposes, they may still be treated as separate entities for other purposes, such as state taxes, employment taxes, and certain excise taxes. Obviously, like I said, the liability protection legally is still there. Additionally, disregarded entity still provides its owner with limited liability protection, as the entity remains legally distinct from its owner for purposes other than federal income taxation. All right, here we're going to see an overall summary of the entities and their attributes. Congratulations. We're slowly making our way to the end of this lesson. It was an absolute doozy, but hopefully you got as much out of it as possible. I know I did. I learned a lot. Just kidding. As the one having to teach this all, I had to know it already. Now, here is just a nice overall view. Feel free to memorize it. I'm not going to particularly go through this. Screenshot it. This will be in the memorization guide as well. Take a look. This is the differences in formation with all of our major entity types, the liabilities of the owners. This is all what we went through together. So take a look and make sure this is memorized. Here, we've got differences between the management structures. With all of these, we've got the transferability differences as well as the taxation differences. I'd say, obviously, the taxation differences are probably the most important because guess what? We are dealing with the tax exam. However, all of the other criteria going to be important as well. And lastly, another entity comparison. We've got our major entity types. Feel free, take a look, memorize this here, and you will be on your way. Sending you off with a bang. Hope you all had a great time with this lesson. I know I did. Thank you all for coming, and I'll see you in the next one. Let's wrap it up with a nice summary and call it a day.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.